a bit of a pop quiz is, what was the average mortgage rate in 1981? And the answer is about 16.5%. Yeah, so we're certainly not there, right?
It's about the long game also.
Right now we're around 6%, and this is a national average, right? This is pulled from Bankrate, not necessarily indicative of the Cedar Rapids market, but I can tell you that I've seen from a couple of lenders, rates are somewhere in that neighborhood today.
I want to say I looked at one of the sheets today, and it was around 5.6 or 5.7-ish.
Yeah, there's definitely lenders that are pushing that, right? The Fed just raised rates on Tuesday, so we may see that even tick up a bit further. So what's going to happen with mortgage rates and potential home values? Well, the Fed is eyeing the 50 basis points increase in June, July, and September. We just saw the one in June, and in fact, it wasn't 50 basis points, it was 75. So it's 0.75%. So if mortgage rates are at 6% today, they may be at with two more 50 basis points increases in July and potentially September. Mortgage rates could be as high as 7 or 7.5% by the end of the year if everything goes according to plan, to the Fed's plan. If it doesn't, and the Fed has to take some more drastic action, rates could be higher than that. I put this material together a couple of days ago, and I anticipated 50 basis points from the Fed. They hit 75, so I was thinking 6.5 by the end of July, but they may be even closer to 7 by the end of July and 7.5 or 8 by the end of September. So what does this mean? If mortgage rates are 7 or 7.5% by the end of the year or more, what does that really mean to the average consumer? In a market like Cedar Rapids, and I would say that's a contained market, whereas a suburb of Chicago is going to be a little differently, right? There's a lot more income levels to play with. There's a lot more lines to be blurred in terms of what community you're living in and where money flows. But Cedar Rapids is fairly isolated, even geographically, and so the median household income is I don't want to say restricted, but definitely much more affected. And so if the median household income in Cedar Rapids is fixed, that means that as the cost to borrow increases, the amount of house that people can afford decreases. And that leads me to believe that ultimately the debt-to-income ratios that lenders use will start to dictate what the median home price is. And so this starts to put a really neat package around the financial part of the equation and what home affordability in a market like Cedar Rapids looks like. If the median household income in Cedar Rapids is approximately $65,000, that means at 28% debt to income would be about $1,500 a month. So now we have to ask ourselves, what can $1,500 a month afford? Well, if interest rates are 7 or 7.5%, at $1,500, interest rate's going to make up a lot more interest portion of that payment. Depending on the amount of money that you put down, whether you put down 5% or up to 20%, the affordable median home price in Cedar Rapids should be somewhere between $185,000 to $230,000. Remember, we just looked, the median sale price was around $230,000 right now. But that's with lower interest rates. We know statistically that the majority of Americans between 50 and 70% have less than $1,000 in savings. What this means is if $185,000 is the amount that you can afford with a 5% down payment and still meet a $1,500 a month mortgage payment, including taxes, insurance, and all that stuff, the majority of Americans are going to be closer to this $185,000. That's going to be more closer to the median. We know that median prices are $230,000. We saw average prices $240,000, $250,000, $260,000 for some listing prices. Over time, as rates continue to increase and wages do not, we expect that home values will come down anywhere between 10 and 20% as a result of the median income in a market like Cedar Rapids.